What's going on, guys? It's Beck, and today we got a brand new video on where the market can go. Is it going to get much worse than where it is right now? And it very easily could. We know the Nasdaq is in bear market. The Russell 2K is also in bear market territory, but the S&P is not in bear market. It flirted with it a little bit before, but is above that. It didn't really technically go into bear market territory. So we know that there could be a lot more downside than maybe a lot of people are expecting. But right now, we had some pretty bad news with Target. They reported that their profit was going to be less than what they already reported 3 weeks ago. And this is the same thing that kind of happened with Snapchat before, where after their earnings, they reported things were going to be bad. And then a few weeks into the quarter, they said that it was just going to get even worse. So we can see right here, this is Target's kind of news coming in, talking about the Target, the eighth largest retailer in the US, issues a second profit warning in just 3 weeks. Their first one was in their earnings when they said, things are going to be a little rough. They didn't think they're a little over kind of inventory, not really having the sales of people buying these things that they've overstocked on. We can see the stock fell 9% in pre-market trading. If we go into kind of this article you're talking about it, this is what they really broke down, saying Target anticipates its opening or operating margin rate for the second quarter will be around 2%. That's lower than the outlook it gave less than 3 weeks ago, when it anticipated its operating margin would be roughly around its first quarter operating margin rate of 5.3%. So Target, it's overstocked in some areas and understocked in others. It's actually kind of crazy the kind of metrics they're going on. But what Target and these retailers do is basically they used to do like just in time kind of ordering, where they would get items just in time. They really wouldn't hang on to too much inventory. They would sell through what they ordered and then order more if they needed to, or switch up to whatever was popular or going to, people were trying to buy, and switch up to that and order that stuff to come in just in time and start selling it. But since supply chains got so bad, they switched from that and went to ordering in bulk and trying to kind of make sure they had stuff to sell to people, but people having the lowest savings rate in multi years now, combined with debt that has just gone right back up to the mean. They People don't have money to really buy the things that they've stocked up on. And with, gas prices skyrocketing, inflation running wild, the just consumer is not in a healthy spot for these retailers to actually be just in this spot where they can kind of hold on inventory, because the consumer is buying necessities and not buying anything else. We can see that here with just kind of all the retailers talking here. You see retailers from Walmart to Gap face a glut of inventory as inflation pinched shoppers skip over categories that were popular during the first 2 years of the pandemic. So, like we saw, the first 2 years, people did have money. The stimulus checks came out, the economy was kind of in a better spot, and people had disposable income to just kind of throw around. So, this stuff that was popular for the last 2 years, people no longer have the stimulus checks, no longer have the unemployment bonus, and they have way more expensive gas. They have inflation running havoc on everyday items and necessities, and they don't have that extra money to kind of throw in what they were before. So these companies, right here, like Gap gives an example. For instance, said customers want party dresses and office clothes instead of the many fleece hoodies and active clothes the company has. So the company, instead of doing this just-in-time ordering, because supply chains are broken, and if they did that, they just wouldn't have any inventory to sell at all. They tried to stock up on what was popular before, but what happened is what was popular before got switched out for something else now that they don't have. So now they have a ton of inventory that in order to sell, they're gonna have to discount it, run sales, and not make a lot of money off of it, which is going to be bad for obviously shareholders and their kind of earnings reports for these companies. And even if people can buy it, even some people, they're not even going to buy it. So you can mark it down, have sales, and do everything, but people still might not buy it because they might just not have the money. So that's going to be very, very bad. You can see even this stuff is kind of outlined here, where you see Walmart said some families are making fewer discretionary purchases as the price of gas and groceries rise. People are buying necessities and not buying anything else. Abercrombie and Fitch and American Eagle both reported a steep jump in inventory levels, up 46% and 45% respectively from a year ago of mixed items that were not that items not selling and supply chain delays easing. So these all these retailers went from their models from just in time inventory and just in time ordering that they wanted stuff to sell. They didn't want to have bare shelves or not be able to get inventory to sell. So they stocked up on things that were popular. Turns out the things kind of swung and people are not really looking to buy things, especially from retailers. These like clothes that were trendy or popular or whatever a couple years ago, people are going to try to either buy office clothes or interview jobs, stuff for jobs, or kind of just not just buy the clothes at all. They're just going to buy groceries, they're going to buy necessities, and kind of this discretionary stuff goes to the side. So these companies are now stuck with that inventory that even on sale and on specials, they can't sell because people aren't looking to buy it. And you can see the target price here. If we zoom out, so today is this, and then we see today was the massive drop down here from 159 down to 158, the 9% drop because of what Target came out and said, guys, our profit's not looking good. People aren't spending money. We ordered all this stuff and we have too much of it. If we zoom out even further, we can see the massive drop from their earnings report when things were really bad, from 215 to 163, kind of bleeding out and just continue going down just because people don't have discretionary money to go around. And this shows even in Walmart too. We see the same kind of news from this. Target news affects Walmart, not as much, but it still affected Walmart. And zooming out, Walmart's earnings went from 148 down to 123, kind of bleeding out here, sitting around 120 to 123. So these retailers are the major retailers are just kind of warning signs showing the consumer not in a great spot. There's just a lot of people out there who are not buying anything other than necessities, groceries, and trying to skate by. The savings we know is down, the debt is high. People don't have the money and discretionary income to spend on the things that these stores have stocked up on. So that's not good for obviously the economy, this kind of stock market. If all these stores have this inventory that they can't sell, that's going to affect obviously their sale, their profits, their earnings report not going to look good. But even if they can't put it on sale or run specials, even just get like a 2% profit out of it, they're stuck with that. They paid for the inventory, they can't sell it. They can't even recoup any of the money. It's a devastating thing across all retailers, and this is obviously going to affect even bigger companies like the Apples of the world. If people aren't buying clothes, are they going to be buying iPhones and iPads and these more expensive electronic items? So, and to just add to this flame here, we have the commodity prices here absolutely skyrocketing. So, kind of the last time we saw this a massive spike up was around 2008, where we see just a massive spike into this 2008 recession, and then the drop down when everything started crashing in 2009, kind of nearing the end of the recession. But we have it right here, massive spikes up from even say from January 2021. It just is parabolic till to April 2022, which is not good, not a good sign for the economy, for the stock market. We've seen a lot of pain in individual stocks, things like Netflix going down 70+%. Coinbase doesn't have a real pretty chart to it. There's a lot of individual companies who have been battered down. And if you were invested in them, you felt it. But the overall market, the S&P 500, isn't even in bear market yet. And so things could get a lot worse. I think energy is the thing holding the S&P up. So right now, it would not be surprising to see things get even worse and see the market fall a little bit more from here. So ultimately, I mean, nobody knows. No one can predict the future of the market. It just economic conditions don't look great, but at the exact same time, the economy isn't the stock market, and the stock market isn't the economy. They don't reflect each other all the time. They're not always correlated. The stock market can rally when the economy is really bad, and the economy can be really good when the stock market falls. So they're not exactly tied together like that. But right now, the retailer is showing consumers kind of weak. Buying things aren't going to be great. That affects earning reports of all companies, and the stock market would obviously go down if earnings go down. This could just be individual stocks, the retail sector kind of showing a little bit of weakness, and that's the thing that's going to be affected the most from these kinds of news. But if it's not, and if it's bleeding over to the overall consumer, to the big tech guys, to the giants, and they start falling, then the index could fall pretty heavily. If something like Apple, which has held on pretty good, starts falling, then that's going to be a big sign for something like the S&P. So we'll see how this plays out. It's definitely not something that you should try and predict and say the market bottom, putting in all my money now, or the market's going nowhere, I'm sitting on the sideline. If you want to be invested in the market, the age-old saying of time in the market beats timing the market always works. If you want to be invested, just dollar cost average. It's the easiest way and the best proven way of investing in any market. But that's going to do it for this video, guys. As always, don't forget to smash the like button and subscribe on the road to 1,000 subscribers. I'll see you guys in my next video.